What's going on, everybody? It's Jeff here. Welcome back to the channel. A monster green close for AMC on a Friday, breaking above that $34 price point, closing just about 1%. In this video, we're going to touch bases a little bit on the charts, but I want to talk about two milestones that have just happened, how it directly affects AMC going forward and the overall market. So let's get right into it. First off, we're going to take a look at the 13F filings. Now, Monday is the last day on that 45-day grace period to report for quarter two. We are still waiting on our favorite hedge fund to report. A lot of action around that $33 average share price, still showing a lot of green coming in. And like I said, we will wait and see exactly what gets reported on Monday. And this is going all through Fintel. But I want to jump over to Market Beat, which I've been covering for probably about 7 months on my channel, and check out this right here. Last time we looked at this, it was at about 500, I don't know, I say 536 million, I actually think was the exact number. We are at 2.14 billion. That is a 18-to-1 ratio for purchases and sold for institutional ownerships coming through as of the most current to date knowledge that we have. That is astronomical. If you can see where this ended up, is a 339 to 12, huge ratio as well, but still 2.14 billion coming through. Going to continue to monitor this to see exactly how that changes going forward, as well as the Fintel coming through on Monday as it's their last day. One thing I do want to point out to where AMC sits right now, we're taking a look at the daily chart. It's finally shown a little bit of a green arrow coming through on the MACD. RSI is still sitting at about $43. As all of these 50-day, 100-day, and 200-day moving averages slowly get brought down as the price has been, declining over the past month or so, you can see that our resistance to where we get back into that blue ocean is just becoming less and less. You see the $37 level on the daily chart. You jump over here to the 4-hour chart and you can see right here we got a little bit of a death cross happening. That crosses back, still $37. We break back into that, which that $37 will show a little bit sign of resistance. Once we can get a solid clean break through that level, it's going to be wide open back into a blue ocean. You can see right here as we poke through it, coming back in around the end of June, didn't get a clean close, a clean break above it, and that resistance held well. Going to be looking to see exactly what happens. Nice little double bottom forming around that $30 to $32 level, as well as that 200-day moving average is acting very, very strong. So that's going to be it for AMC. Volume has been a little bit stagnant. I want to get into this right here. This is talking all about the margin debt. I'm going to explain to you what it means for the entire market, what history has shown us in the past, and how this can directly affect AMC. So as you have been aware by now, and I've covered it a few times on my channel, it's been all over the internet, some of these new rule filings from the DTCC coming out talking about automatic margin requirement, getting rid of that personal level, making it on a computer-based level, as well as deposit requirements have literally 25x from that $10,000 per member to $250,000 per member. You can see a lot of these hedge funds are starting to change their positions. And let me point this out, margin debt and the market, it is down 4.3% in July. It's the first decline in 15 months. So what does this tell me right off the bat before I even look at the charts? The fact that these large institutions, excuse me guys, and hedge funds are potentially seeing that the market is getting a little bit toppy. That comes from just a technical standpoint, let alone the fact that their margin requirements are going to be modified in order to protect the market from a catastrophic, crash that we had in 2008 that just absolutely decimates the economy. They're trying to prevent that, and a lot of these guys have just been completely over leveraged. So that's what it tells me on the first forefront. The market's getting a little bit toppy. We've seen the S&P. I've showed you the charts numerous times, how we hedge our portfolios to be able to prevent on some of these, or prevent some losses on these downturns. But if you take a look at this chart right here, and this is going all the way back to 1997, as you can see right now, this red line is the margin debt. Insanely overextended. Once the market pulled back in the S&P after the coronavirus lockdown, we hit that double bottom. They pumped everything that they've had. And because the Fed's easy money policy, the stimulus, the loans, the lack of student loan payments, I mean, the list goes on and on. These investors just saw that the market was just going to run insane because the amount of capital that was just pumped into the economy, and they took every single dollar that they could borrow and dumped it into the market. Now, I even remember last year when I was, all over the internet telling everybody that, yeah, I'm running at probably only a 10 to 15% cash on hand right now. And I had everything in the market. And now that has slowly gone back to a 20 to 25%, 30%, 40%. I'm not even really adding to any of my long positions that I have that I'm already green on. I'm kind of just waiting to consolidate and playing very, very short positions because we're getting to a frothy point. And as you can see right here, the amount of margin debt has officially declined. It's come down for the first time. And as you can see, as history going back, always say when you're looking at the charts, look to the left. It's a really good indicator of what's going to happen to the right. Look to the left. And as you can see right here, back in 2000, when that margin spiked, it came down a little bit. It was the first to decline before the S&P followed. Same thing in 2007, 2008. That line look at the gap here. It got extremely far away. And that's why I had to come down. But the market continued to run for a couple months after that initial decline in margin debt came through. And as you can see, it's kind of followed all the way through. A little bit after 2011 came through, dipped a little bit, market came down, had to run all the way up to 2015. Pulled back a little bit. I remember 2015, I was purchasing another house at that point, and we were already talking about the housing market being overextended. Little do we know where we were going to be at. Some of those homes I have valued are 30% to 40% have higher value than they were back in 2015, but it kind of came back. Same thing 2018, a little bit of choppiness going through here. And then the coronavirus recession, and then just an insane run. And as you can see right here, the margin debt has come down, but the S&P has continued to run further. So historically, this is kind of what the charts are telling us for the entire market. Now, how does that relate to AMC? Well, let me just explain it to you. When it comes to margin, there's a certain amount of percentage that you have, okay, and that hedge funds will be able to have, and it's all different. You might be leveraged at 50%, it might be 2x, 3x, it might even be 10x, and you're going to start to cut some of your positions that leave you the most exposed, that give you the highest risk. Meaning, if you have stock in Apple, and for every $1,000 you have, you're able to buy $10,000 in Apple because it's been a very solid company. The chart isn't too volatile, it's very steady. That might not be the first position you're going to close if you're over leveraged. However, if you are invested in other stocks that you might even be red on, that you only have a 50% margin, meaning you're only able to, let's say for every $1,000, you're only able to buy $2,000 worth, those are the positions that you're going to want to close quicker in order to be able to raise your liquidity. So as the market begins to pull back, the amount of availability for their margin is going to go down because their securities value decreases. Meaning right now, if your security value is 100,000 because stocks are at all-time high and stocks begin to pull down to 80,000 and you're one-to-one leveraged, well, you used to be able to have 100,000 in margin, but now you only have 80,000 in margin because your security values have decreased. So any stock that has the potential to be insanely shorted, which also has a lot of buying pressure behind it, like AMC, has a very good potential to be able to force some of those shorts to have to cover some of their positions, close out their positions, or just modify exactly where they are. So we're going to be keeping a very close eye on this. As far as the entire market, if you are investing in anything else than AMC, just be very careful. In the group, I tell everybody we're playing much shorter positions right now, looking for insanely oversold stocks, looking to kind of get in and get out a little bit quicker, still playing a lot of the large caps. The small caps are really not where the money is right now, and just getting those small base hits are really going to be beneficial for you. So I'll keep you posted. I'll see you in the next one.